save you money over your lifetime, starting with some big updates now. We're going to be diving into ways to make your money grow further and how to prepare for the financial surprises that tend to pop up this time of year. And as always, if you want to be on with me, call me now, 800-321-0710. We're live on YouTube. I don't know, in a little bit of time, I'll be live on X. So stick with us. No matter where you are in your financial journey, mid-career, nearing retirement, already retired, or today's show is full of strategies to help you protect, grow, and make the most of your money. We're also going to talk about charitable giving, your retirement accounts, or simply trying to wrap up the year in the strongest position possible. And as always, talk to many people this week. Their financial advisors are taking the next 2 weeks off. Shame. Shame. Right, Nicole? Like, this is the time, we're not tax people, so we could take off during April 15th. But these last few weeks of the year are critical. Now, we take off on Christmas Eve, Christmas Day, New Year's Eve, New Year's Day. We are available during market hours. What are market hours on Christmas Eve and New Year's Eve? We're available via the phone if you need to make trades, but we don't meet with clients those days. However, we pretty much, if you need something done, now that's on you, if it doesn't get done, but we try to help everybody get those year-end QCDs done. And we have a lot of people that move and become our client because we're around during these critical periods in the year. So give us a call now, 800-321-0710. Christmas Eve, the market is open until 1 p.m. It's funny. I think the market should close on Christmas Eve. And then the market is also open on New Year's Eve. People don't know that. So, actually, no, it's not. It doesn't do that. The bond market closes early at 2, but the stock market's open until 4. Wonder if, is the market hour January 2nd? Is the market open January 2nd, 2026? Sometimes it is, sometimes it isn't. No, it's open. Looks like it. So, money never sleeps. It's funny. Remember with the Robinhood, Nicole, did you follow the Robinhood saga and people wanted, people to trade all the time, 24 hours a day, 7 days a week?
No, not really.
That was a big thing that the Reddit people were saying. Oh, the market should be open all the time. I don't know if I like that, but markets have become increasingly more liquid and increasingly more 27, like the Forex markets, but some of these things that are going away were actually good. So give us a call, 800-321-0710 if you have questions on stocks, bonds, charitable giving, and year-end tax strategies. We're talking about that today. And any and every financial education question you have, we are here for you live. If you have questions on stocks, bonds, annuities, mutual funds, whatever question you have, no question is a dumb one except the one that you do not ask. So I just, little shopping tip. So I ordered shark bands. We'll see if they work. Have you heard about these?
Shark bands?
They're these things you wear on your ankle so that when you're paddling in the ocean, sharks don't bite you. So they had a buy 4, get 1 free special. But they didn't put the 5th one in the cart. So I sent an email. And you know what? They were nice. They said, sure thing. Which color would you like? So also throw it open to the studio, to the hotline at 800-321-0710. Did you buy anything this year that you're proud of? You know what? I'm trying to help my wife more with buying for the kids, 7 kids. It's a lot of work. I don't think, I don't really know if she relaxes the days from New Year's, Christmas, Thanksgiving to Christmas. She's just, planning Christmas cheer for 7 children. So, it's a lot of work. I got to do stuff to help her on that. So, what are you doing for the holiday season? What are you doing for Christmas? What are you doing for Hanukkah? Are you buying any gifts this year? This year, we're giving the gift of financial education. And as the year winds down and the holidays are in full swing, many people think about giving back. But few realize how much smart charitable planning can also improve their tax picture. Charitable planning is big at what we do at the Jalinski Advisory Group. But few realize how much smart charitable planning can also improve your tax picture. In this segment, I'm going to break down the most efficient ways to donate, how to maximize your deductions, who benefits the most from itemizing, and the strategies that can help you, the listener, keep more of what you've earned while supporting the people you love and the causes you love. But first, we are live, taking your calls on all matters financial. So if you have questions, now's the time to chime in, 800-321-0710. First up, timing matters. You got to have your cutoff for contributions by December 31st. Checks must be mailed and online gifts completed by year-end to qualify. Standard deduction versus itemizing. Many taxpayers don't realize they no longer get a deduction for charitable giving anymore unless they itemize. One way to benefit is by bunching deductions in alternating years. Let's say you give to your shul or church 10% of your income. And let's say, you make 80 grand a year. 10% of 80 is 8. Let's say you have 8 lying around for next year. You could give 16 by December 31st. God sees the heart, so if you bunch your deductions to get a little extra tax write-off, I don't think God minds. It could help you be a better steward. But you could literally give 8 January 1, but you've give it in December's, but tell the church, hey, use that for next year's needs, use this one for this year's needs. There's also something called a DAF, or a donor advised funds. They are a powerful way to front load a large charitable gift for a big deduction this year. We can help you set you up with a DAF. It also allows donors to take the deduction now, but distribute the charity later. It's great for people with a high income year. Let's say you have a big bonus, stock options, business sale, etc. And part of what is at our heart is to give back. Remember the Care Bears? Did they have the Care Bears when you were little? Nicole? Yeah, I loved Care Bears. Like the real ones, the old ones? Or they probably modernized it for you.
Yeah, maybe they weren't. Maybe they weren't the original.
Double check. I think they were, I don't know, second generation. I think I was first generation Care Bears. But I would be the Share Bear, because we're sharing financial knowledge. And when they, stick their bellies out or whatever in the rainbow, did that happen when you were a kid? Did they have the rainbow come out of their belly? Or
yeah, that one I'm not familiar with.
Yeah, it was kind of freaky or psychedelic or something. They might have gotten rid of the creepy, elements of it. I think that the little bears would have like a signal on their chest or their belly, and then they would like...
They all shot rainbows out of their stomach?
I really believe so, yeah.
I'll have to look that up.
It was pretty freaky. So they would unite to spread cheer. We unite to spread Christmas cheer and Hanukkah cheer with the rainbow of financial knowledge coming out of our bellies. So it allows donors to take the deduction now, but distribute to charities later. So one of the things we do One of the things we pride ourselves in as a company is giving back to charity. It is instrumental. We gave to the GBU Foundation, kind of a cool charity. You give, let's say, $5,000 as a company, they will give $2,000 to your favorite cause, right? And then you can nominate a charity to give 10. So and certain other financial companies have matching gifts that we take advantage of to give to our favorite charities that are near and dear to our heart. We support people on missions trips and all sorts of things to go to the unreached and kind of war-torn areas. We're big into helping those who are victims of persecution, kind of spreading awareness of what's going on in Nigeria and elsewhere. So giving money to causes greater than yourself, it's a huge one. And is that a specialty of your financial advisor? Well, if not, it's something we could help you with. 888-988-JOSH. 888-988-5674. And up next, we're going to talk about giving highly appreciated stocks and how you can avoid capital gains. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind: to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now, 888-988-5674. And get your free copy of Josh's book, The Retirement Reality Check.
And we're back talking about giving highly appreciated assets. We're live on YouTube. Do we got any YouTube questions? YouTube, search for The Financial Quarterback. Giving appreciated assets is one of the most tax-efficient ways to give. Let's say you have a lot of stock. You made a lot of money in AI stocks. Well, you could give that highly appreciated stock, and guess what? You don't have to pay any tax on it if you give to your favorite charity. Donors avoid capital gains tax and receive a deduction for the full market value. It works with stocks, exchange-traded funds, mutual funds, and even in some cases, real estate. So if you have questions about charitable giving, call us now, 800-321-0710. That is our listener call-in line. Next, we're going to talk about the QCD. Everybody wants to know about the QCD this year. It's available for IRA owners 70 and a half or older, and it counts towards your RMD if you're 73 or older, but is not included as taxable income, so you avoid the dreaded IRMA tax. That is the income-related Medicare adjustment. A win-win for retirees who don't need the full RMD. What about charitable remainder trusts? This provides you with an income for life if you give to a charity, and then the remainder goes to your heirs, so you're not giving the remainder to your, the remainder actually would go to the charity. There's charitable lead trust, charitable remainder trust, so you can structure it a couple different ways. One is you get an income for life, and then the remainder goes to charity, and then you get a big tax write-off. So let's say you have no children, but you want to be financially responsible. You need an income for life. Well, you can set up a charitable remainder trust. And in many cases, the charity will pay for the legal expenses. And we know some lawyers that will do this. They're very giving. They will discount some of their fees because it's going to charity or charge you a reasonable rate. And in some cases, your charity can even pay to have this done. This can help reduce estate taxes and diversify highly appreciated assets. But here's my tip. Sometimes people will say, well, what about, I want to give to Hillsdale or whatever, right? I don't like their giving because you know what they do when they, no, I'm not saying to not give to Hillsdale. I'm saying ask if you can control the investments. So in a lot of these plans, they have their people and then they come in and they're managing your CRT where it's funny, we're helping them get a big gift. So make sure you stress that you want your financial advisor to help you manage it. If you don't, that's fine. You use their people. But the point is, in some cases, some of these charities are like, okay, we have our attorneys and advisors so that we don't need, it's like we're doing all this work. In some cases, not charging for our time on this to help a charity. And then it's like, thanks, but no thanks. So make sure you can control your investments in the trust. Pick your custodian, pick your advisor. That would be a caution for me. If you don't care and you just kind of want to use their people, that's fine, but then they should pay the bill on it. Now, it can help reduce estate taxes and diversify, giving you an income for life, like an annuity, but you can invest in stocks and bonds and mutual funds. It's a great benefit. We got an email from a listener friend. She says, good morning. I will take my RMD in 2026, so not to have two RMDs in 2027. If I wait for 73 in March of 27, yeah, you can wait till you're 73 and a half. If sent directly to the parish, no tax on it, and income will affect my senior exemption under $58,300. I don't need a charity deduction. Planning ahead, and I gave less in 2025, so not overgiving. There's no such as overgiving, but if it doesn't fit your budget, I certainly understand. There's no better thing to do than give. So next we're going to talk about cash gifts versus non-cash gifts. Cash contributions are capped at a percentage of your adjusted gross income. So you got to talk to your accountant or tax professional to see how much that cap is. This is like, you're a millionaire, you want to give a $500,000 gift to charity, you got to watch that. Non-cash, but it could be, you're a $100,000 and you want to give a $50,000 gift, so you just got to be careful. Non-cash and appreciated asset giving often provide larger tax benefits because you can avoid the capital gains and you get the deductions. So we're taking your calls now at 800-321-0710, 800-321-0710 with any and every one of your questions. And Nicole, you had some questions. Go ahead.
Yeah, I do. I was wondering, with so many people taking the standard deduction, who actually benefits from the charitable tax breaks today?
Everybody, particularly people over 70 and a half with the QCD. But I have people who are 40, they give to charity. They'd rather the government get less and their favorite charity get more. So anybody who can double their deductions up, that's the whole idea called bunching. Anybody who has an IRA, that's the strategy called the QCD. Anybody who has highly appreciated stock. But if you're taking the standard deduction, here's the thing. I believe you should give, regardless, even if you take the standard deduction, come on, give a little bit to charity, But I think anybody could take advantage of it.
Okay, so kind of a follow-up. I'm not very well versed with donor-advised funds. Can you explain why they've become such a popular tool for particularly high-income families and business owners?
The DAFs, people are getting daffy about the DAFs, the donor-advised funds. because you can get a big write-off. You know, you have a big bonus or a really high income year. You're a giver by nature, but you're like, hey, I may not always be blessed with this amount of money. The beauty of the DAF is you can control how it's invested. You can literally grow it in the stock market. And then every year you give off a little bit to charity, almost like a little private foundation without all the administrative expenses. So it's a powerful way to get tax benefits. I'm a big believer in the DAF because sometimes, like, I don't necessarily trust a charity with, you know, I want to look at, you know, how financially accountable they are, what are they doing with the money. But sometimes I don't necessarily like, you know, how they're investing it. So I want to be in control of that. And the beauty of the DAF is I can control how it's invested, yet it's going directly to charity and I get the write-offs. It's a very powerful tool.
So we're, 5 days out from Christmas? And I think a lot of people are probably expecting or hoping for a nice Christmas bonus from their employers. So if somebody is expecting a large bonus or they have a big capital gains year, what charitable strategies should they be considering before December 31st?
Well, one thing you could do is I would wait. If you're going to give contingent upon giving a bonus, I would make sure you're getting a bonus. I'm hearing a lot of people this year are not giving a bonus because of the economy. You know, you know, it's kind of sad some people aren't getting what they were expecting. So make sure you get it first before you give, if that's why you're giving. Now, let's say you make X and you want to give 10% of X, regardless, because you're a believer in tithing, or you want to give 5% to charity, or you want to give 15, whatever it is. You know, you can write that check out before the end of the year. Now, we hear a lot about this. You can give appreciated stock, let's say some AI stock that you have in your favorite brokerage account. You could give that. If you don't know exactly how much you're going to give for bonuses, you could write a check out. I try to get a lot of my gifts done by year end, for sure.
And then we have a listener question who they're a retiree and they want to know how qualified charitable distributions, QCDs, from IRAs can help reduce their taxes.
The big thing with the QCD is that you don't get a deduction, but the income from the IRA doesn't count against your income. So it's even a little better because sometimes when people take an RMD, it causes their IRMA to go up. That is your income-related Medicare adjustment. And we're having many of you who call us at 888-988-JOSH saying, I want IRMA planning. I want QCD planning. Call us and 888-988-JOSH. Now we have dedicated staff standing by live to schedule your no obligation QCD review. But the beauty of the qualified charitable deduction is it can help you avoid the dreaded IRMA tax.
What about giving appreciated assets instead of cash? Why does that often make more financial sense?
Well, you know, because you get a double benefit. You get the deduction and you get the avoidance of capital gains taxes. So it's very powerful. Charitable giving is one of the few strategies where doing good and doing well can go hand in hand. Whether you're writing a year-end check, gifting appreciated stock, setting up a DAF, a donor advised fund, or using more advanced tools like QCDs and charitable trust, the right planning can make a powerful difference for both your taxes and your favorite causes. And I want to stress, charitable trusts are a big tool. Like, if you're single, no children, and you want income, and you're like, I'm worried about me, but I don't have anybody I want to leave my money to, or I want to leave my money to my nieces and nephews, but I also want to leave a lot to charity. A charitable trust is just a powerful vehicle where you can get a massive write-off now for leaving money to charity later. If you want to explore these strategies and fit them into your financial plan, reach out to our team at the Financial Quarterback. We'll help you finish the year strong and set up your giving in the smartest way possible. Our number again, 888-988-JOSH. That's 888-988-JOSH. 888-988-5674. We'll help you finish the year strong and set up your giving in the smartest possible way. Give us a call. And up next, we're going to talk about no income tax. Sounds great, but what would it really mean? I love it. We'll talk about that later. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Maybe it seems like the prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind: to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now, 888-988-5674. And get your free copy of Josh's book, The Retirement Reality Check.
For calls live, 800-321-0710. So I believe that income taxes will not be hard to replace. I think income taxes are the way to go. They are confiscatory and they hurt the producer. I believe tax is a form of theft. And I believe that if Trump has his way, tariffs could be a wonderful replacement of income tax revenue. Now, the idea of eliminating income tax would be amazing. Who wouldn't want a bigger paycheck and fewer April headaches? And the government would save all the revenue from the IRS being disbanded. President Trump has floated the idea of replacing income tax with tariffs, suggesting the government could fund itself through import taxes instead. There are countries that do this. Look at the Cayman Islands, for example. Now, the ripple effects could bless everyone, from your grocery bills to retirement income. Today we're breaking down what that means and why I love it. This is just one of the greatest ideas in the history of the last 100 years. You know, we didn't have an income tax before 1913. You know, we had it temporarily in the Civil War. And we can thank the progressive era and Karl Marx and Woodrow Wilson, that academic from Princeton who wanted to screw up the producer. The reason why I think income taxes are so egregious is the founders wanted to tax, their concept was to have use taxes, meaning like you use a road, you pay a toll. You use an educational system, maybe you have an educational tax. But to tax one's ability to produce could be horrible. So I am a big believer in using tariffs only if we use those tariffs to offset income taxes. I don't want, no tax on tips, no tax on Social Security. I want no income tax if we're gonna have the tariff trade, because tariffs do raise the cost of things, but like clothing, electronics, cars, and appliances, and I'm willing to bear that cost only if. And the other nice thing about a tariff is it can't be hidden. Like, people, it's gonna be passed down the consumer, So Jeff Bezos is going to pay his share when he's, making his yacht. So I think it's a blessed thing. What say you? Give us a call. 800-321-0710. We're talking charitable giving. We're talking income tax as a replacement for tariffs. And we're taking your calls on all matters financial. So I think if we go with this tariff thing, we got to eliminate income taxes. And that would cause this amazing, thriving ingenuity. A lot of people, they give up on work. A lot of successful people I know, they give up working because they give up active work because they're sick of paying income taxes. And they get tax bills like $1 million a year to the federal government. They go, well, why am I doing this? So I think it would incentivize people to go back to work, to be more productive to the economy. And we'll see if Trump gets his way on the tariff issue in the Supreme Court. If he does, I'm only going to be happy about it if they stand for no tax on income. So what questions you have, Nicole?
Well, so I'm just wondering if somebody is, nearing retirement age or they're even currently retired, would this, replacing the income tax with tariffs, would that affect them significantly?
Well, I hope so. It would mean no RMD, no required minimum distribution, no IRA taxation. It would be amazing. No loopholes, no set-asides, no, if it was tariffs, it would show up in the cost of goods. No one could avoid it. Illegal immigrants who are in the country, they don't like illegal immigrants, right? Like, we've been hearing about illegal immigration for years, right? They're not rounding up everyone and sending them out of the country. And generally, those people are paid with cash. Now, if it shows up on the price of goods and services, they can't avoid it. So they're contributing to the society now, to the tax revenue. We hear so much about, Elon Musk or Jeff Bezos doesn't pay an income tax. With the tariff, he won't be able to hide it. It'll be on the price of his yacht. So I'm a big believer in tariffs, only if they replace income taxes. I'm not for income taxes plus tariffs, or either the current regime with no tariffs or getting rid of the current tax regime and just having a tax, a tariff issue. And we'll see if it can raise enough revenue, but I hope so.
It historically have tariffs been used as a primary source of government revenue in the U.S. before?
Oh yeah, big time. The early founding of America, that was a big thing. The 1800s. Not been a while. It's been about 100 years. We've had tariffs on and off. The Biden administration was a believer in tariffs, as was the previous Trump administration. I think the idea of a tariff is they're putting it on a good from another country so that our goods produced here are more competitive than goods from countries with cheap labor. Now, conceptually, I'm not for that. I'm a big believer in free trade. I personally think we should have no income tax and no tariffs. And go back to use taxes or something like that. But, I'm a dreamer, so it's not. I think in the tariff issue, I'm only for it if they get rid of the income tax.
So what about somebody who has a portfolio with a bit of international exposure? Would increased tariffs change how they should think about diversification?
Maybe, but here's the crazy thing. We've had the tariffs this year, and international stocks are up gangbusters this year. So international funds have done swimmingly well, which you wouldn't have thought, You thought other countries would be penalized. And you do worry about retaliatory tariffs, but I think generally eliminating taxes, income taxes is the way to go if Trump gets his way on tariffs. If Trump doesn't get his way on tariffs, I'm all for a flat income tax. You know, people spend so much time going through, you know, we spend so much time as business owners, you know, dealing with this from the Department of Revenue, dealing with this. So next up, we have Darren. Go ahead. He's questioning
I'm
my
just
proposal.
wondering, like, if I have most of my money in the Roth retirement account, how would that be fair if all of a sudden, you know, for the people who have the tax deferred, how would that be fair for someone like me who has their money in the Roth and have paid the taxes on all my retirement money over the years?
Here's the thing, you would be, we've all paid into the system in one way or another. I mean, I've paid years as a business owner. You know, I pay a lot to the government. But I think your unique situation, it's kind of, you know, no disrespect, kind of a selfish take. You not pay tax on other IRA distributions or other forms of income or Social Security tax. I'm sure you pay taxes on other things. So it would benefit you, it would benefit the economy in that it would reward job creators, producers. You know, we always talk about, you know, these tax things, and Trump did them in COVID. You know, okay, here's a $2,000 tax. Here's a $2,000 gift from the government. And then people use that to buy, you know, TVs or food or whatever. It doesn't really generate the type of economic growth where if you told a job creator you don't have to pay income taxes, you don't have to worry about paying these high burdens, man, they would hire more people. It would send a boom to the economy. But I think your unique situation of, well, I did this Roth strategy. I'm not saying it's going to happen. I'm just saying I hope it's going to happen. You know, I'm still a believer in Roth, even though I want this to happen, right? But that's why some accountants don't, you know, tell people to do Roths, because they think, okay, well, what if they abolish the income tax code? I mean, but how likely is this? Is that really? But I want to put it out there because I think it's on my Christmas wish list, and I think we need to eliminate income taxes for economic productivity's sake. Also for fairness, I mean, I'm in a school district too where sorry about property taxes. We pay property taxes for a school system that's dying, and we have like 3 high schools in our town. We should have 2. I mean, why reward financial mismanagement by the government? So hope that helps, Darren. But it would help you in other ways. I'm sure there's other things that you pay taxes on. And if, you know, for example, if Amazon didn't have to pay income taxes, well, what would they do? They'd probably lower that cost. And if they wouldn't, there would be competitors, so it would lower costs in goods and services. So hope that helps, Darren. Thank you for the call. Next up, we have Gordon. Go ahead, Gordon. We'll take a short break, and then we'll be back with Gordon on what is the best fixed income investment these days. When we return, this is Josh Jalinski, the financial quarterback, talking about the elimination of income taxes. And up next, Roth IRA contribution changes coming in 26. We'll be back after these messages.
Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind: to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now. 888-988-5674. 5674 and get your free copy of Josh's book, The Retirement Reality Check.
We're back. This is Josh Jalinski, the financial quarterback. We're on with Gordon. Gordon, good to hear your voice. Go ahead.
Yes, Josh, it's me. I'm not an AI creation this week. I'm live also. I wonder, with the interest rates on bank CDs and the U.S. short-term treasuries on the decline, what do you think is the best way to get fixed income, the best fixed income investment at this time, considering the interest rate and security of the investment?
Well, I mean, this is a great question. I mean, I've been telling people for the last, I don't know, how many years, Gordon? 3 years, 4 years?
Yes. Yeah.
That we are having an epic period of fixed investing in the country. I mean, you could still get, by the way, 5-year 5% fixed annuities. I don't know if they do 10-year fixed annuities at 5% anymore. I think we were seeing rates as high as like 6%. So MIGA's multi-year guaranteed annuities. I like certain municipal bonds are still paying good rates. Treasuries I like them, but they're starting to dip down to like 3 3/4. So you got to be mindful. You got to be able to pivot. You got to be able to call an audible with the financial quarterback. It's one of these things where you had this glory day. We've been with each other for so long, Gordon. Remember from 2000, I don't know when you started listening to me, 2010, 2008.
Shortly after you started on WOR.
So somewhere around then. But from 2010 to 2021, people would say, oh, I long for the days of a 5% CD. What I would give for a 5% CD. We had that, folks, for the last 3 years. And what did you do? I'm not saying you, Gordon. I'm saying people in general. Some of you didn't call. Some of you didn't take advantage of the greatest period for fixed income investing in the last 15 years. Now, we have a narrow window of time where you can still get good rates around 5, 4.7 I saw 5 this week, but there is an expiration date. There used to be 100 companies that offered a 5 or more % rate. And people go, for whatever reason, I'm going to do the 1-year CD, Josh. I'm going to do the 18-month CD. And what did I say? I said, I get it, but if you have an emergency fund of 1 to 3 years in the bank, consider tying up that money for longer duration, like 10 years. That way you could get those higher interest rates for the next so many years. And that's the same thing with bonds. We're still seeing, good municipal bond rates. We're still seeing good annuity rates. And if that interests you, if you want to lock in, and people say, what about bad annuities? I've heard good, bad, the ugly. Yeah, there are good ones, there are bad ones, just like there's good cards and bad cards. You buy anything. We want to buy ones with a low fee or no fee. And you can buy annuities that, let's say it's a 5-year MIGA, you pay 0 internal cost. You only pay if you cancel within the 5 years, and you can take up to 10% out, penalty free. Now, there's a surrender charge if you take out more than 10%. That's typically the only negative on those. But there are so many options still, but it's narrowing, it's shrinking, and I think we wake up next year, we have a different Fed chairman that wants lower rates. I'm telling you, or we haven't experienced a 20% market meltdown with that new Fed chair. Boom, rates go down. So watch us, follow us on YouTube, hit the subscribe button, follow us on Twitter @YourFinancialQB, and any other follow-ups to that, Gordon.
One short question, if you don't mind.
And folks, call us at 800-321-0710. Be like Gordon and Darren. Go ahead.
Suppose someone has a life insurance policy, a whole life life insurance policy that they find they no longer need. Is there any way they can sell this for profit to some entity?
Yeah, there's something, what is that called? Settlements, life settlements. But I would want to see what type of product you have, what you could get. I would shop around. I would get 3 different quotes from 3 life settlement companies because it's sort of it can be a seedy industry. And if you have a good whole life, you might be able to take the cash out yourself as a dividend or as a loan. So if that's something that's interesting to you, call us at 888-988-JOSH. Eliminating income taxes sounds simple, but the financial system isn't. Taxes don't always disappear, they shift. Whether it's through higher prices, reduced benefits, or increased debt, households may still pay in one form or another. The smart financial movement isn't reacting to headlines. It's understanding how policy changes will affect your cash flow, inflation, and long-term planning so you can make informed financial decisions no matter what happens next. So give me a call today at 888-988-JOSH, 888-988-5674. We'll talk about Roth IRA contribution changes. And Mo up next. This is Josh Jalinski talking about strategies to minimize RMDs when we return.
Maybe it seems like the prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
We're back, and we got Mo. Big Mo talking RMDs. Go ahead, Mo. Mo. M-O-E.
Taking RMD. Can you hear me?
Yes, go ahead, Mo.
Okay. I'm taking the RMD. I know it's the end of the year. I have already contributed enough to charity, etc. Instead of giving it to the government. My question is there any other way we can avoid taxes on the RMD other than contributing to the charities?
Well, one is to do strategic conversions because you can't take an RMD from a Roth. The other is from age, 59 and a half to 73 to slowly spend down your IRAs. You could also look at bracket filling. So if you have, I don't know how much you have in IRAs, but let's say you have $1 million in IRAs, maybe you take out 200 grand over the next 5 years so that in year 6 you don't have any RMDs. So you look at smart RMD planning. You could look at creating tax offsets. So for example, you could buy an Airbnb, rent it out, take the short-term rental losses from your real estate against your income. So there are creating tax offsets. You could start a business. I talk about this actually in my book, Retirement Reality Check. I talk about ways to minimize taxes and minimizing your RMDs. You could do the QLAC strategy. That will minimize RMDs. You could but I like the offsetting of the tax with real estate. That's sometimes a good strategy. I like the Roth strategies, also insurance contracts, life insurance contracts, taking money out slowly out of your IRA because life insurance and Roths do not have an RMD. Does that help, Mo?
Yeah, it looks like, new idea. So what I will do is call your office and make an appointment and go over.
Wonderful.
Obviously, on the right now, it's hard to go over all the plans. I'll do that. Thank you for your suggestions. Have a wonderful holidays. Thank you.
You too. Wonderful. Yeah, 888-988-JOSH. But there are a lot of ways to minimize RMDs over your lifetime, even if you can't now. Dan wants to take Social Security early, so that means next hour we're talking Roth IRAs. Go ahead, Dan.
Hi,
Dan.
Josh. It seems that most financial planners, they're taught to tell people to delay taking Social Security and wait until they're older. And I think everybody should start getting away from that idea because, first off, you cannot inherit Social Security. Your Social Security balance is gone if you die at a somewhat early age. That would allow your 401k plan money or IRAs to build up in money if you decide to take your Social Security sooner than later. And that strategy should be looked at.
Yeah, no, I'm a big believer in what you're talking about, but there's no one-size-fits-all strategy with Social Security. I mean, I've been talking about Social Security for years. Your life expectancy matters, right? Like if you die at 71, you should have taken it at 62, right? The break-even point is somewhere around 81 to 84. So you have to look at your unique plan. Like if you're somebody who's going to put all your money in the bank, earning 0 to 1%, then delaying Social Security is generally a good strategy because you're getting an 8% bump from 62 to 70. If you're somebody who's going to put that money in the stock market and you're okay with the growth and the risk of the stock market, you're right, you can have that compounding grow. Now, you do leave, if you're married, you leave the higher of the two checks to your spouse. So there is a strategy having one take it early and the other delay. But you are very right. A lot of financial advisors, they just give a blind blanket statement, delay, delay, delay. It doesn't always work that way. And you bring up a good point. You know, take it early and let your accounts compound and grow. So I think you have a good point. It doesn't always work, and I don't always tell people to take it early, and I don't always tell people to delay. Everybody has to get their own unique Social Security calculation. And if you want that done, call us at 888-988-5674, 888-988. Josh, any other questions on that, Dan, before we go?
Well, the other part, comment on that factor is that nowadays, most husbands and wives are working full careers. Their Social Securities are pretty much equal. So this thing about waiting whoever has the higher payment, that doesn't apply anymore. You don't have housewives.
No, it still applies to a lot of people.
Their whole career.
No, it still applies to a lot of people we've seen over the years. It may not apply to you. That's my point is there is no one size fits all, right? Like you got to run your numbers. And then what we do when we run numbers is we show pro formas of what if you let the market grow? I mean, what if the market crashes? Then it wasn't a good idea to take it early. I mean, there's a whole lot of factors. If you die early, it's best to take it early. If you're living till your 90s, it may be better to delay. If you put your money in the market and the market experiences a lot of growth like it has over the last 10 years, probably best to take it early and let the market rebound. So if you have a spouse that you guys make a similar income, then there is some truth to what you're saying. I think that there can't be a blanket take it early or delay. I think the problem within the financial planning community is people want a one-size-fits-all solution.
WOR and WAXQ HD2 New York.
An iHeart radio station.
Guaranteed human. From the heart of New York City, the voices you trust. 710 WOR, the voice of New York.
An iHeart radio station.
It's 32 degrees at 10 o'clock. Good morning, I'm Bill Trefiro. Does someone in the house have the sniffles? Well, listen up. Flu season is picking up steam all across the U.S. New data from the CDC released yesterday shows nearly 5 million flu illnesses have been reported nationwide so far. The report says New York City is showing the highest level of flu activity, while at least a dozen states across the U.S. are seeing moderate flu activity. The CDC estimates there have been at least 49,000 hospitalizations from the flu so far this season and about 1,900 deaths. It's the kind of urban tale that makes some people afraid of going to the big city. Bricks falling from the sky in Manhattan. Yes, it happened yesterday. Andrew Whitman has more.
It happened in the wind around 4:30 Friday afternoon at the intersection of Park Avenue and East 49th Street in Midtown. 4 people on the sidewalk were hurt. 2 were hospitalized. All should recover. The buildings department says a window washer rig on the roof got loose, hit the brick masonry at the top of the building, and sent the bricks over the edge and down to street level. The building was issued a violation in order to put up protection for pedestrians.
Congresswoman Elise Stefanik is ending her campaign for governor and will not seek re-election to the House next year. In a post on X, the upstate New York Republican says her decision was not made lightly. In an interview on Friday, Stefanik said it's just not the right political time. That according to the Albany Times-Union. She also says she wants to spend more time with her 4-year-old son. More than a dozen people are recovering after 2 New Jersey transit trains made contact last night. The incident, described as something less than a full-on collision, it happened just west of the Bay Street station on Montclair around 7 p.m. Friday. In all, 17 people were injured. All are expected to recover. No word on what caused that accident. In sports, the Knicks lose to the Sixers 116-107 at the Garden. It's the Knicks and Heat tomorrow. The Nets host the Raptors tomorrow. NHL action, the Islanders lose to the Canucks 4-1 at UBS. The Devils win late in Utah 2-1. The Islanders in Buffalo today. Rangers host the Flyers this afternoon at the Garden, and Devils back home to host the Sabres tomorrow night. Football action tomorrow at 1. It's the Jets at the Saints. The Vikings play the Giants.
Here's your WOR Weather Channel forecast. Temperatures will get a little bit warmer into Sunday before falling behind a front into Monday. As far as the Saturday, some sunshine. Winds will be lighter today with a high of 38. Then clouds will increase overnight with a low of 34. Sun will break through the clouds tomorrow afternoon. It will be breezy with a high of 44. And a sunny and colder Monday with a high in the mid to upper 30s. I'm meteorologist Jeff Marr.
Next News 11, bulletins at once. Curtis Lewa returns to guest host for Mark Simone Monday morning from 10 till noon. I'm Bill Trefiro, 710 WOR.
Tired of losing money in the stock market roller coaster? Frustrated with the government taxing you into oblivion? Worried about inflation? How do you prepare for so many financial uncertainties? Welcome to the show that will help you develop your game plan. The Financial Quarterback with Josh Jalinski. Josh is a noted financial advisor and president of the Jalinski Advisory Group, and he's here to answer your questions. Call into the show at 800-321-0710. 800-321-0710. Now, let's kick off your financial future. Here's Josh Jalinski.
Okay, we're back. This is Josh Jalinski. Nicole and I were talking. That guy made no sense. Not everybody makes the same income. I mean, no disrespect, buddy, but the claim that all spouses make the same income today, that's just not true. Everybody has a unique income story. And when it relates to Social Security, even if you make a similar income to your spouse may take off 5 years or 10 years to raise the kids, and that would negatively affect their formula. Everybody's different. So it's like to say blanketly delay. I think the point that's valid is too many people say delay when it shouldn't be delayed. But it depends what you're going to do with that money. It depends your life expectancy. A lot of things that you can't control. You can't control your life expectancy. You can take care of yourself, but you can't control the market returns. What about the people who retired in 2000 and experienced 3 negative years of the market? What about if the AI bubble bursts? We have many of you calling 888-988-JOSH for the year-end review. 888-988-JOSH. Keep calling if you want the free book when you schedule and keep your no obligation review. So call us 888-988-JOSH. Also, we're taking your calls on All Matters Financial at 800-321-0710. 800-321-0710. If you have a question for me, now is the time to chime. We are talking about Roth IRA contribution strategies. It was funny. I found that one guy interesting, Darren. He was all worried about tax policy. Number one, I wish what I said would come true. But, it's more me dreaming. But you really would not want income taxes eliminated because you took a Roth conversion? I mean, yeah, theoretically, you'd be like, oh, I shouldn't have done that. But, I'd be happy with it. Wouldn't you, Nicole?
Oh,
no
yeah.
income taxes?
For sure.
Okay, next up, we're taking your calls on All Matters Financial at 800-321-0710. 800-321-0710. Roth contribution changes are coming for 2026. Roth IRAs continue to be one of the most powerful retirement and tax planning tools. And 2026 is bringing important changes. This is, of course, if the tax regime remains the same. Contribution limits are increasing. Income phase-outs are shifting upward. And the current tax brackets now made permanent, Roth strategies may become even more valuable. We're going to break down what's changing, why it matters, and who should be paying close attention before the new year. The Roth IRA contribution limits are increasing in 2026 up to $7,500, up from $7,000 in 2025. So one really good strategy you could do is put in $7,000 now if you haven't, and then $7,500 January 1. Why? That gives you $14,500 working tax-free for all of next year. If we have a market, upturn. Now, there's people who would make a big deal about timing Roth conversions. We talk about this a little bit. Timing it to do it in a crash. You know what? There's been studies now that kind of have debunked that strategy that says even if you invested in market tops, if you wait it out, for 5 to 10 years, you should be fine. $8,600 total if you're 50 and over, with the expanded $1,100 catch-up contribution. So if you're 50 and older, you get the catch-up. You can also make 2026 contributions all the way till April 15th, 2027, but I don't really advise that. Get that money in working tax-free right away. Income limits are also rising. The full contribution allowed, if your modified adjusted gross income is $153,000, under $153,000, or under $242 if you're married filing jointly, $153 if you're single. Then there's something called a phase out that ends at $168K for singles or $252,000 for couples. Above that, you can't contribute directly, and there could be penalties to that. Roth IRAs differ from traditional IRAs because contributions are after tax, but the withdrawals are completely tax-free if you meet the age requirement and the 5-year rule. Next up, we have John. Go ahead.
Hi, how you doing, guys? I'm 74 years old, and I was going over my tax paperwork from years ago, and up until I've been collecting Social Security because I'm 74 years old, and I'm working part-time. And up until 2017, in the summertime somewhere, I would get a paper from Social Security adjusting my Social Security where I would get, like, let's just say $12 increase in my Social Security, and my wife would get $5 or $6 increase because I've been paying Social Security taxes while I'm working. They stopped sending me those letters in 2017 from what I could see. Is there something that I had to file to have it adjusted every year? Do you know?
No, you go on SSA.gov. You have to register online. And if that's not you, if you're not an online person, do you have a child that could help, or a kid or friend? Have you ever logged into your SSA.gov account?
No, I haven't, no.
So you need to go to SSA.gov, register. Go to SSA.gov, register, and check your work history. If your work history is wrong, you need to go directly to your Social Security office and tell them that and request an audit of your income. It should generally be correct, but they don't mail that anymore. They've gone paperless to save postage, which I'm okay with.
Oh, I see. Okay, so in other words, I'd have to look at my Social Security statements going back and see if they gave me the increase because I do direct deposit.
Yeah.
So maybe I didn't pick it up.
And then
What you
also,
saying? I should go back?
yeah, well, I would go to ssa.gov, check your work record for 2018, 2019 through today, 2020, 21, 22. If you worked, make sure they recalibrated it due to those earnings. Make sure they have a record
okay.
of those earnings.
Oh, okay, because up until that point, till 17, it seemed like they did it automatically. I didn't have to
I think
file
they do
anything
do it
or anything like
automatically.
that.
They do it automatically, so it should be right, but you want to make sure it's right. That's why they would send it every year, because maybe your employer wasn't claiming you or something, you know, or somebody at the at your employment made a mistake. So just double check it. Go to ssa.gov and register. And that's really what anybody should do if they want Social Security planning. They should make sure part of our 6 game-changing playbooks is income planning. And one of your checks that you get an income from is Social Security. So you want to make sure that they're calculating it off the right numbers. And then we would put that into our system. If you call us at 888-988-JOSH, everything's confidential, and we see, hey, are you making any mistakes? Did the government make any mistakes? I don't know if do you remember those shows that used to do where they would talk about all these mistakes the government would make on people's Social Security? So we would have Larry Kotlicoff, and he would talk about all the scandals at the Social Security Administration. Not saying that the people, you know, did it, you know, people work for the government are bad people, but anybody can make mistakes, so just double check. Measure twice, cut once. You don't want to measure once and cut twice. So, hope that helps, John. We're going to take your calls, folks. All hours, 800-321-0710. And John, if you want to meet with me to make sure they're doing it right, call us 888-988-5674. Roth IRAs have no required minimum distributions at age 73, unlike traditional IRAs. Other benefits of the Roth: contributions, not earnings, can be withdrawn anytime, tax and penalty free. Sometimes people think they got to wait for the 5-year rule. Yeah, that is for tax-free treatment of earnings, not the other. Also, these accounts also offer tax diversification in retirement, and Roth withdrawals don't count towards income calculations for things like Medicare premiums or IRMA. Parents and grandparents can contribute to a Roth for someone else as long as that person has earned income and you don't exceed their annual earnings or the contribution limit. So let's just say your granddaughter worked as a lifeguard and made $4,000 this summer, but she spent it all. You as the grandparent can call our office. We set up a Fidelity Roth IRA for her. And guess what? The beauty of that is she gets tax-free growth her entire life. You can use her work history to still contribute, even though she's not the one contributing, because you want her to have spending money. So that's a great gift. That's a great Christmas and Hanukkah gift. A subtle but important planning detail: under recent legislation, current tax brackets are now permanent. They will not revert to the higher pre-2017 levels. This may make Roth contributions even more attractive for many savers. Those are the 12% bracket, the 22, and the 24. So if you're in those brackets, you may want to consider a strategic Roth conversion. Up next, we're taking your questions on Roths and questions all hour at 800-321-0710. This is Josh Jalinski, The Financial Quarterback. Don't touch that dial.
Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind: to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now, 888-988-5674, and get your free copy of Josh's book, The Retirement Reality Check.
Nicole, you have some questions for me.
Well, so I'm just wondering, with these higher contribution limits and income thresholds, who do you think benefits the most from the upcoming changes?
Everybody who makes under $168,000 if you're single, $252,000 if you're a married couple. Those are the people it benefits mightily.
So how should listeners think about whether a Roth IRA or a traditional IRA makes more sense for them right now?
Well, it depends on what state you live in. You know, if you live in a zero tax state like Florida, I love the Roth. I love the Roth even if you're in a high tax state like New York or New Jersey, because money coming out of a Roth is state and federal income tax free. I think it depends on your bracket. I think if you're in a 24% bracket or below, you may want to look a little bit more heavily at a Roth. But I also think if you're in a higher bracket, if you're like super wealthy, where you have estate taxes, you may want to look at a Roth conversion to lower your taxable estate and then have that money grow tax-free as well. Traditional IRAs make sense more for people with high incomes who are looking for greater deductions right now. Maybe they're in a like a professional athlete or a business owner who may not make what they're making now for the next, for their lifetime, but they may have a short window where they can make money. And so they're in like a 30-40% bracket. Traditional might make sense for them. A Roth makes sense for a lot of people right now who are retired, who have RMDs, stuff like that as well. Or people, the 10 years prior to retirement, let's say from 73, from like 59.5 to 73, those are also people a Roth can make a lot of sense for. If you do a strategic conversion, which is you don't take it all out, you look at your tax bracket and kind of look year by year.
Okay, so with tax brackets now made permanent, does that change how aggressively people should be considering Roth contributions or conversions?
Totally. I mean, you have, one of the things we do when you come in for a review at 888-988-JOSH is we have this amazing software where we run your 6 game-changing plays. And one of those plays is the tax planning play. And so let's say you're in the 12% bracket and there is unused 12% tax dollars. You want to Roth up to that limit. If you're in the 22% bracket, you want to Roth up to that limit. If you're in the 24%, you want to up to that limit. We saw somebody yesterday. She's in the 24% bracket this year, but next year she's in like the 30s. So we wanted to take advantage of the 24% bracket. So definitely, now that tax brackets are made permanent, you all should be looking at whether a Roth conversion makes sense.
What about for people whose income goes above the new limits in 2026? Are there any strategies that they should know about specifically?
Yes, this is an important thing to distinguish. A Roth conversion is good for anybody at any income level. So you might think, man, I make over that limit. A Roth contribution is good only for certain people. people who make under that income limit. So they both make sense, and they both could be right for you, but depending on your income, a conversion may be applicable to you and not a contribution.
Are there still ways for them to get money into a Roth?
Yeah, the conversion. So if you make too much money, you could look at doing a strategic Roth conversion, which I'm a big believer on if possible. Go ahead. As always, planning early and understanding the tax rules ahead of time can make a massive difference in what you keep and what you give up in taxes during retirement. Roths remain one of the most powerful tools out there, but the Roth IRA rules keep shifting, and 2026 brings opportunities people shouldn't overlook. We have some tax certainty for the first time in a while. If you're not sure how these changes fit in your overall retirement plan, call me now at 888-988-JOSH, and we'll sit down with you to make sure you're maximizing every advantage available to you. Our number again, 888-988-5674, 888-988-JOSH, and we'll sit down to make sure you are taking advantage of the Roth. So call us now, 800-321-0710, if you have a financial education question for me. Up next, are these the top 4 retirement withdrawal strategies? This is I had a guy, his name is, we'll call him Jimmy. He's from Louisiana. Great guy. He'll know who he is if I'm talking about him. And amazing man. He's a truck driver. Really amazing guy. Saved $850,000 for retirement as a truck driver. Isn't that amazing? And he was a missionary. And he said he on the rope and road, he's listened to many books, a plethora of books on retirement planning. And he says that my book is the best book he ever read. And, this wasn't the New York Times review. It was the Jimmy review. And I was so touched by that, because here's a guy who, he has the Audible. He said he bought like 1,000 books on Audible on finance or something like that. And he said, mine's the favorite. You know why he said that?
Why?
Because he knows how to grow his money. He doesn't know how to spend it. He doesn't know the right spend down strategy for him. And this is the thing. After decades of savings, you face a challenge that Jimmy is alluding to. Figuring out how to spend your money strategically. What is the order of spending? What is the timing? Where should you take your withdrawals first in retirement? And it can dramatically affect your taxes, the longevity of your savings, and future financial flexibility. And today we are breaking down 4 powerful withdrawal strategies. Tax efficient withdrawals, number 1. Tax bracket management, number 2. Flexible planning, number 3. Creating a paycheck-like income stream, number 4. To help you keep more of your money and avoid the hidden traps that can quickly crack your nest egg. Let's first talk about making tax-efficient withdrawals. Not all withdrawals are taxed equally. First thing I told Jimmy when we met, he read my book, Retirement Reality Check, wanted the free review, and which is still available if you want us at 888-988-JOSH. We have people calling in, trying to get their year-end review. 888-988-JOSH. Well, we got Roth accounts are tax-free. So if you take money out of a Roth and you've met the 5-year rule, all withdrawals are tax-free. If you started a Roth 3 years ago, your contributions are tax-free. You just wait on taking your interest. Not a big deal. Taking money out of savings banks or checking or cash equivalent, because you are taxed on those dollars every year with a 1099 INT form when you pull money out, you're not getting hit with a big tax bill. unlike the traditional IRA, 401k, certain annuities, where you are taxed at ordinary income rates when you withdraw that money up to 37% federal and 10% state. This is one thing that irks me. People don't do enough planning on considering the impact of state income taxes. You get people like Mamdani who says, we're gonna make New York City more like New Jersey. Well, I don't know anybody who wants to emulate New Jersey's tax system, except an idiot. I mean, think about this. I'm not calling him an idiot, you know, but it's like, it's dumb. It makes no sense. Who says that when I grow up one day, I want to be just like New Jersey's tax system? Nobody. Now, Pennsylvania, you could say they have a 3 or 4% flat tax, no loopholes, so that could make sense, but not New Jersey. I mean, give me a break, you know. But if you take money out of 401k under the Mamdani regime or the New Jersey tax regime, you could be taxed at 37% federal, 11 state. That's like 48 cents almost on every dollar if you're in a high tax bracket. Even if you're in a lower tax bracket, like the 24% bracket, still got to pay like 5-6%. So you're paying like 30 cents on every dollar, state and federal, when you take a withdrawal out. Have you thought about that? So that's why step one is to create a tax-efficient withdrawal order. Now, taxable brokerage accounts often get favorable LTCG or long-term capital gains treatment, which might be 15% tax instead of federal income tax. And that's one of the things our software does, where we will model out what capital gains will do and what income taxes will do. So your withdrawal order matters, my friends. Whether you take out a cash and savings, taxable brokerage, traditional retirement accounts, and Roths maybe last to maximize decades of tax-free growth. Now, Tommy was different, or you know, whoever we're talking about, Jimmy. Jimmy was different. Jimmy was like, hey, I don't want to leave as much. I mean, I love my kids, right? But I want the tax-free growth I want a tax-free income for life for me and my wife. So we flipped this, and he wanted tax-free income for life from his Roth. And then if the kids pay tax, they pay tax. Because he's worked so hard. I mean, the guy's working until he's like 70 roughly. Example, needing $10,000 could cost as little as $10,000 in a Roth or savings account. But if you need money from a traditional IRA in a 22% bracket, you need $12,821. That doesn't even count state income tax. So when you say, hey, I want 10 grand to spend, you got to withdraw $12,821 from the traditional, pay the government $2,821, and you get 10. The key point is the less retirees pay in taxes now, the more their money can last for years to go. And when we return after the break, we're talking next about managing tax brackets carefully. One poorly timed withdrawal can push retirees into a higher tax bracket. And we'll talk more about that next when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And
maybe it seems like the prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind: to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now, 888-988-5674, and get your free copy of Josh's book, The Retirement Reality Check.
Okay. Next up, we're talking about managing tax brackets carefully. You want to avoid the $1 more mistake. David said the guy listened to the book 3 times. No, I think it's up to 6 times now. It's either 4 or 6. Now, one poorly timed withdrawal can push you into another bracket. So avoid the $1 more mistakes where a small withdrawal triggers hundreds or thousands of dollars in extra tax. But, if, let's say, you do the math wrong and you pull $10,000 out and you didn't realize you were going to get a 1099 from, I don't know, a brokerage account with another 10 grand. If you're only paying that extra tax on the 10 grand, it doesn't make, it's not the end of the world. Don't get too paranoid. Where it does matter more is the IRMA. That can push you into an extra premium that you can't get rid of. So this is the whole idea. You want to test these withdrawal strategies, and we have the software to do it, where you can manage your tax brackets a little more carefully. Now, we are not claiming to be CPAs or tax professionals. We will work with your CPAs. I have CPAs we work with as well if you need a recommendation. Now, a retiree near the top of the 12% bracket pulls $50,000 from a traditional 401k to help a child buy a home. Much of that withdrawal is taxed at 22%, turning a $50,000 gift into a $61,000 withdrawal. So retirees often think, oh, I'm taking 50, but then I realize they got to take 61. And then on that extra maybe 10 grand, they're paying an extra 2,200 where they would have paid maybe $1,200 in taxes. So a key point here is when you're doing these strategies, and we have this, we can do bracket filling, aim to fill your lower brackets first to not jump into higher ones. I had somebody this week who was very cognizant of this. She was calling her other broker to get those data points, and nobody got that data to her. So we could help try to get that for you. If it's a year-end issue, call us at 888-988-JOSH. Point number 3, be flexible as life circumstances can change. Taxes dramatically shift when you retire. Stop working, claim Social Security, or start taking RMDs at 73. A flexible strategy allows retirees to take advantage of low-income years. Another thing that guy who called on Social Security was clueless about, how many retirees just have like 400 grand in cash? There are people, you know how many people, Nicole, I meet with? They have like $1 million of cash. They have 500,000 cash.
Yeah, I believe it.
Earning 0.01%. Remember the darling 90-year-old lady this week who a listener friend brought in and brought his aunt in, and I think we calculated she had $1.2 million earnings like 0.2% or some ridiculously low number. So for that person, the 8% bump on Social Security does make sense if they're not going to invest that in the market. Now, I'm a believer in the market, but it depends on someone's risk profile. A flexible strategy allows retirees to take advantage of low-income years, use Roth conversions at favorable tax brackets, and reduce future RMDs, and avoid bracket creep later in life. And folks, we have about just 23 minutes left. If you have a financial question for us, so call us now, 800-321-0710. Now, after retirement, income drops. Between retirement and age 73, retirees often have a tax window to take IRA withdrawals or complete Roth conversions at 10 or 12% instead of 32% later when RMDs kick in. I mentioned, somebody yesterday showed him how to bracket fill up to the 24% bracket because next year she's moving to 32. Also, when you have a spouse pass, that's another form of bracket creep. Generally, you go from married filing jointly, and the tax regime is worse if you're single. The key point, sometimes the smartest move you can make is to pay taxes now at a lower rate to avoid a tax train wreck later. Now, here's the thing. We got the one guy who was calling and saying, oh, what about a Roth? What about me? Because I'm kind of selfish, right? But, wouldn't you like to not have to deal with this crap? For the rest of your life? You have no income taxes? Wouldn't that be good? It's just baked into the TV you buy? I find it to be better. Number 4, create a consistent paycheck. Who wants a retirement paycheck? I don't know about you. I do. Do you want paychecks and paychecks? As an income stream, market volatility can often cause emotional stress for retirees pulling from investments. Our good buddy Jimmy that we were talking about, he did not want market volatility on his income. He was a believer in the market. He wanted to know when he retires at 70, he's going to make, 80 grand a year for life. And we showed him how to make 40 grand from his Social Security, 20 grand from his wife's, and another 40 from annuity. So he was up to about 100 grand a year in guaranteed retirement income while him and both his wife live. But he wanted that to be tax efficient. So he bought a Roth annuity, and he got, what's better than income for life? Tax-free income for life. If you're interested in that, give us a call. Market volatility can often cause emotional stress for many of you, which causes you to pull from investments at exactly the wrong time. That's why we recommend putting 1 to 3 years in a volatility buffer, or to do GSI by setting up an automatic monthly transfer to mimic a paycheck. We've been doing this for years. I can help you create a paycheck. This creates stability and keeps retirees invested long-term, even through market turbulence. Key point, a predictable monthly income improves discipline, peace of mind, and portfolio longevity, meaning your money won't run out before you die. So next up, we have some questions. If you want to call me now, 800-321-0710. 800-321-0710. I did want to talk next about gift giving. So after this, any purchases people are buying. We didn't do the gift giving episode.
We still got time.
Okay. When do we have time?
Well, first I have a question about
Go
this,
ahead
and
with
then
Roth.
and then
Sorry.
we'll do gifts. So I just wanted to know if you could elaborate a little bit more about why the withdrawal order is so important when you're retiring, because it seems like that's kind of a point that you were hammering.
Well, let's say you love your niece and nephew and you have no children. Why should they pay no tax on the Roth, right? When you paid the tax on the conversion to avoid taxes. So this matters also in different life circumstances. There is no one size fits all. So for Tommy, loves his kids, but he views whatever they get as a bonus, right? He works, I don't know, a guy works 10 on, 10 off, 10 hours on, 10 hours off every day, driving a tractor trailer or something like that. So for him, he's at 70, I want to be done. I want to go to the mission. He wants to become a missionary at 70 and help other people. And that's a very admirable calling. And part of that would be as if he doesn't have to worry about taxes on the withdrawal order, that's like getting a 20% pay increase. But some people do the Roth, and they want, most people kind of want to leave the Roth tax-free to their heirs and let that build. There's no wrong answer. But the withdrawal order is critical both to help that money last as long as you can and have enjoyment of your life, like you, right? If you were to leave money to your niece, you might love your niece, but you'd rather go to that nice dinner. You'd rather go to that have the nice car, and whatever they get's a bonus, right? Am I wrong?
No, yeah, that's true.
So everybody kind of has different legacy goals. That's why one of the 6 game-changing plays that we give people is the legacy conversation. You're leaving a legacy whether you have kids or not, and people forget that. So withdrawal order matters. I hope I made sense of that. Did I answer
No,
that?
you did. That was good. But I'm also curious
Because it's not what you keep. It's not how much you have in your account balance. It's what you get to keep and enjoy at the end of the day that matters most.
Well, so that kind of leads to my next question, because you talked about paying taxes on purpose in the earlier retirement years, but forgive me if I'm wrong, for some reason to me that sounds counterintuitive. Why is it the opposite?
What's counterintuitive?
Paying the taxes in your early retirement years, wouldn't you want more then?
Well, some people want to pay more taxes from 62 to 73 because once you hit 73, you have to take the RMD. So you're going to be slammed with those taxes. So by having the strategy to take maybe money out of your IRA, put it in a Roth from 59.5 to 72, you can build your tax-free bucket bigger earlier. So I hope that helps.
Okay, yeah, that makes sense. But so the tax window that you talked about, that's between retirement and RMD age, how big of an opportunity is that for things like Roth conversions or strategic withdrawals?
It's huge because, you know, also if you're married filing jointly and then you go to single, the taxes get worse. So for many people, it's better to do it while both spouses are alive and not wait till one passes, but too often, and then the IRMA tax goes up, and there's all these, you know, nightmarish changes that affect people.
So if somebody's listening right now and they're feeling kind of overwhelmed, what would like a simple paycheck style withdrawal plan look like?
You put, I don't know, we'll use an example I saw this week. Somebody put 380 grand to an income for life annuity. That's a fixed annuity with an income rider, fixed index. And they put in something like 380, and then in 4 years they'll get 38,000 a year for life, guaranteed. Checks every month, 38 grand divided by 12, plus Social Security. They have nothing to worry about. That met their basic expenses. So then the other money can grow and compound in their Roth tax-free or in their stock accounts. So a lot of people don't want to worry. You don't want to worry about your money like every day. You know, people worry so much about their money, like just get a paycheck, play check. And also, I want to make very simple because it can get confusing, this withdrawal order and the tax window. Think of it this way. If we flesh this out, let's flesh this out with tax brackets, just as a simple example. Now, there's also IRMA brackets, but the individual income bracket for 2025 is, so let's say you were a single taxpayer. So from 100 grand of income, 100,526 to 191,950, you're in the 24% bracket. You're in the 22% bracket if you're making between 47,151 and 100,525. So let's say you make 80 grand a year in retirement income, and you're single. You could convert up to 20,525 plus deduction, so you could convert more. I'm just oversimplifying here. You can convert 20,525 with no bracket hike, meaning you stay within the 12% bracket. You don't get pushed up to the 22% bracket. This is why this is important, because as your accounts compound and your RMDs compound, you may be thrust into that higher bracket. So I hope that helps. Any other follow-ups to that?
I mean, I guess you also kind of mentioned that retirees can accidentally push themselves into a higher tax bracket. Why does that turn out to be such an expensive mistake?
Because they don't think through the tax filling. They don't have the proper tax filling software. And if you call us at 888-988-JOSH, during the break, 888-988-JOSH. We'll give you the 6 game-changing playbooks. When you schedule and keep, we'll do that conversation for you, and we'll help you build a smart, flexible plan so your savings can last as long as you do. Because with the right withdrawal strategy, you can stretch your dollars, lower your taxes, and help you avoid the costly mistakes that many retirees make. If you want to make sure you're pulling from the right accounts at the right time, in the most tax-efficient way, call me now, 888-988-JOSH. That's 888-988-JOSH, 888-988-JOSH. Up next, we'll talk about money mistakes that quietly wreck your plan. This is Josh Jalinski, the financial quarterback. Don't touch that dial.
Josh and his team at the Jalinski Advisory Group can help you lower your taxes and lower your risk in these uncertain times with a 27-point checklist designed to improve your financial health. Whether you're worried about runaway prices, fear of an upcoming recession, or a stock market meltdown, tune in to the Financial Quarterback and count on Josh Jalinski to call the play. For a free copy of Josh's book, The Retirement Reality Check, call 888-988-5674. That's 888-988-5674.
Looking to lower your taxes or need help securing your financial future? Then Josh and his team are the people for you. They're experts in financial economics with one mission in mind, to protect you and your investments. From their 27-point checklist to their one-of-a-kind financial quarterback approach, they help you achieve financial health and guide you through the hard times of high inflation, looming recessions, and stock market meltdown. For financial security, call them now, 888-988-5674. And get your free copy of Josh's book, The Retirement Reality Check.
Okay, we're back. Holiday gifts. What's going on with your holiday Christmas gift shopping? Nicole, what are you doing?
Ooh, okay, so I have 2 young nieces. And my one niece, Ray, she's 5 years old, and she loves getting into anything. She loves science and, anything kind of witchy and mysterious. So I found this potion kit, and it's kind of like a combination of chemistry with like wizardry and like Harry Potter stuff. She also loves Harry Potter. So I think she's gonna be really excited about it. And it was not really expensive. And I think it's my favorite gift, I think, that I'm giving. Because I know she's gonna love it.
Yeah, I remember my sister gave these like Teenage Mutant Ninja Turtle things to my kids, and they loved it. Like little nunchucks and sais and these weapons, and we took it on the plane after Christmas last year or the year before, and they confiscated them.
Why?
As a weapon. They were a plastic toy, which was sad because it was one of the favorite gifts my kids had. They loved it.
Did you replace them when you got back?
Did we replace them?
Yeah.
Oh, yeah. Yeah, we might have, or she might have rebought them back. But, we got, they got so many toys. I'm always pumped about giving baseball gifts. And folks, if you have a Christmas or Hanukkah gift idea or where you're going for deals, give us a call, 800-321-0710. I always love to shop at Costco. That's a tip because for me, they should be sponsoring the program. But, it's always like one of these things where I think I get time back in the holiday season because I used to, scour the circulars to go to Target or Walmart or to figure out who was the best deal for this particular gift. And for the extra couple bucks you might spend at Costco, you can buy with peace of mind generally because they'll return it. So I kind of like that better now, and it's given me hours back in my holiday season. So in my Christmas gift giving season.
Well, I was just going to jump in and say one tip that I have learned recently is that Target will price match like almost any other large stores pricing. So if you're at Target and maybe you don't have a Walmart near you, but you see that Walmart is selling an item for $20 less, if you go to the register at Target and you show them on your phone that this item is less at Walmart, they will usually price match, which is great.
And I think Best Buy does that. I think a lot of them do that now, right? Some of them stopped price matching. But yeah, price matching's good. I just like the return policy at Costco. You know, I find it's more difficult to return at some of these places. So let's talk as we round out the show. We're going to take our final break of the hour. And when we do, we'll talk about money mistakes that can wreck your financial plan. Most financial trouble doesn't come from one bad decision. It comes from a series of small, repeatable mistakes that slowly squeeze your cash flow and limit your options. From spending too much on the holidays and subscription keep to overspending on homes, cars, and credit cards. These habits can quietly undermine even good incomes. Today we're talking through the most common financial mistakes people make, and more importantly, how to avoid letting them derail your long-term plan. I'll talk about that next, but we'll take our final break of the hour. And if you have a question, call me 800-321-0710. We have room for one more question, 800-321-0710. We'll be back after these messages.
Maybe it seems like the prices can't get much higher, or that the stock market is headed for bear territory, or maybe you're worried about another great recession. Josh Jalinski, the financial quarterback, can help you protect your family's financial future in times like these. Call 888-988-5674 to take advantage of Josh's 27-point plan to achieve financial health. And when you call, you'll receive a free copy of Josh's book, Retirement Reality Check. Call 888-988-5674 to receive your free copy of Retirement Reality Check.
Back. Small spending leaks add up faster than people think. Unnecessary spending isn't evil, it just needs to be intentional. Dining out, coffee runs, and entertainment can quickly drain thousands per year. The real issue isn't spending, it's not having a spending plan to enjoy your money and to also do it responsibly. Recurring expenses lock in lifestyle inflation. Gym memberships, apps, streaming services become permanent obligations. Consider cutting one or at least two recurring subscription services to free up meaningful cash flow. A leaner lifestyle creates breathing room during tough seasons. Credit cards can magnify your financial mistakes. High interest can turn convenience into long-term pain. Buying non-essentials on credit often leads to spending more than you earn. Credit cards should be tools, not survival strategies. You should pay them off every month. Big ticket items can also crush your flexibilities. Car and home purchases can be emotional purchases too. Even if you need one, make sure you don't buy a house emotionally. With long financial tails, it might be hard to sell it if it's a mistake. Being able to afford the payment isn't the same as affording the asset. You need to factor in taxes, property taxes, home insurance, maintenance, and utilities to avoid overspending. And by the way, even if you're retired and you have enough money to be okay, still map out your cash flow. It's important to do so, and we can help you with that at 888-988-JOSH. Also, not saving or investing leaves no margin for error. Living paycheck to paycheck creates vulnerability to even the smallest disruptions. Emergency savings can protect you against job loss, recessions, and unexpected expenses. Skipping retirement investing means trading your future self for present comfort. If you're not saving at least 10% for your retirement, you shouldn't be, buying stupid stuff. Using home equity or retirement savings to fix short-term problems is an issue. Home equity can feel like free money, but adds risk and interest. Raiding retirement accounts kills compounding and invites penalties. Fixing debt without changing behavior often will lead you right back into debt. The biggest mistake you can make this holiday season, no clear financial plan. Let me give you a Christmas miracle. Without a Christmas plan, our Christmas gift to you will be a clear financial plan. Without a plan, money decisions become reactive. And a plan creates clarity, priorities, and confidence. Even a simple roadmap beats guessing your way forward. You have room for one more question, Nicole? Or two?
Well, I was wondering, you talk to a lot of people every day. What financial mistake do you see hurting people the most long term? Like overspending, debt, lack of planning?
Lack of planning, because if you religiously save 10 to 15% of your pay in an investment account and you avoid high interest credit card debt, you could spend here and there and splurge. But if I don't see people with credit card debt, that's going beyond month to month. Like if you pay off your credit card every month, that's good. If you don't, you should not have a credit card. You should cut them up and go back to the envelope method in cash. And so I would say lack of planning 1, debt 2, overspending 3. But if you keep your credit cards low and paid off every month, and you're saving 10 to 15% of your pay religiously, you are generally going to be financial success, no matter what.
So if a listener is feeling overwhelmed, what's the first financial habit that they should focus on fixing right now?
Getting out of credit card debt first, building an emergency fund number 2, number 3, saving 10 to 15% in a long-term retirement vehicle. And folks, financial success isn't about perfection. It's about awareness and consistency. Most money mistakes are fixable, especially when caught early. The key is being honest about where your money is going, building margin into your life, and making decisions with both today and your future self in mind. A solid financial plan, our legendary retirement game plan that we'll give you, doesn't eliminate mistakes, but it can help you recover from them faster and avoid repeating them. Give me a call today and let our team help you get started. 888-988-JOSH.
The preceding program was sponsored by the Jalinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and Top of the $1 Million Roundtable,